time and we'll get started. Welcome to the Giliberto Levy High Yield Investor Conference, also known as the GL2. It's kind of amazing. This is the 8th time we've done this. And I think both Michael and I can remember being in a little small conference room with a little small table, and we were all, I'd say, crowded around, except it wasn't a crowd. And now we've just got a remarkable attendance. So welcome. Just a couple of items to start. We're going to do this a little differently than most conferences, where you go and you listen to the presentation and then you ask questions at the end. You can certainly wait, but we don't recommend that. So what we'd suggest to you is, if you have questions during either my or Michael's part, there's a little button down the bottom that says Q&A, answer it or ask it. We'll try to get as many of those questions done. And if we don't get to yours, then we will either call or email you with an answer after the conference. I know people are always concerned about asking questions because they don't want their name used. So as always, if you ask a question, we will ask them anonymously. In other words, no name, no corporation. And again, if we have to, we'll respond to you afterwards if we didn't get a chance to get all the questions answered. There are a lot of new participants this year. So if you're a first timer to the GL1 or the GL2, welcome. We're delighted to have you. Due to the number of new attendees, we're going to start with a few basics. And of course, if you're a veteran, you've been with us 4, 5, 6, 7 years, please stand by. We're just trying to, have everybody start on the same sheet of music. Housekeeping, a note, all of you are on mute. So again, the way to talk to us is to click the Q&A button down the bottom. I might mention to you that all of our slides are copyrighted. And if you'd like to use them in your marketing or for other purposes, please just call or email us, and we'll make every effort to let you do that. The intent is that you use the data that we give you. All right, so this morning we've got a couple items, as you can see. We're general welcome. We're going to give you an overview of the index, again, mostly for the new guys. We'll talk a lot about performance, a lot about research and analytics, and Michael will drive, and including our new section on return attribution and the concluding remarks. So let's get started. Julia? There we go. The GL2 is, we think, the index for high yield CRE debt, or private credit as it's being called these days. We measure total return and its components. It's important to note that the GL2 uses loan level data, and that data comes directly from the investors and the lenders. It's very consistent with other fixed income indexes, including the GL1, which is our longtime fixed income first mortgage index. Stock indices are used the same. Real estate indexes, including the NPI and the IPD, again, they're the same. We've designed this for you if you're a portfolio manager or an investor or a capital allocator or a consultant. And one of the things we've noticed is that there are quite a few more consultants this year than we've ever had. So if you're in that consulting business, welcome. We're delighted to have you. Additionally, I might mention to the consulting world that we now have a quarterly index summary review that's available to consultants on request. So if you'd like to be added to that list and you meet the title of consultant, send us an email, call us, we'll get you on the list. Interestingly, the index size has just grown remarkably. We'll talk about this. We now have data on well over 1,000 positions, and we are in our 14th year with more data to come. It's interesting, Michael, I can remember in early conventions, in these early meetings, somebody would ask, do you have, 5 years or 7 years of data? And I laughed hysterically because I was delighted to have 5 or 7 months. But now we've got 14 years, so we can go back and look at the 1 year, the 3 year, the 5, the 10 performance. If you are new, again, this is the GL2, which is high yield. The GL1, which is really the kind of data that you'd want an insurance company's general account to look like. That's fixed rate first mortgages only. Interestingly, if you're interested in that, we now have in the GL1 over 50 years of data. And no, I'm not that old, but thank you anyway. And in addition, over $1 trillion with a T. Hard to believe. All right, so here to start the introduction is my partner, Michael.
Thanks, John. And again, let me add my welcome to everyone who's on this, and also a welcome to anybody who might be listening to the recording after the fact. As usual, I'm going to give a very quick overview of the index. As John mentioned, we have a lot of new folks joining us today, and it's perhaps helpful for some as a refresher, even if you are know of the index. So it's a total return index, and let's click ahead. The data collection and the production of the index are quarterly, but if we click again, we do the returns on a monthly basis. So the monthly returns, we have a start and end of month valuation. We get cash flows during the month. They may be at the first day or the last day as well. So we compute an internal rate of return for the month. Then when we go to multiple months, we chain link to get quarterly returns, annual 1 year returns, 3 year, etc. All of what we do is GIPS compliant. We use GIPS compliant calculation methodology for the IRR, and the chain linking we do is also what GIPS advocates for. And this calculation method is identical whether we're looking at a single loan, whether we're doing a portfolio, or the entire index, or even a sub-index. The total return, of course, consists of an income return and a capital value return. The capital value return is where we pick up all the effect of fundings, principal payments, disposition of loans, and most importantly, changes in the value of the loans that come in. And importantly, these changes in the value are those told to us or submitted to us by the participants. So very much like what's done with the NCREIF and MSCI private real estate equity indices. The GL is not doing any valuation, nor are we auditing the values that are coming in, which could be a mix of internal and external. So this is in contrast to the GL1, where we do at GL do the pricing of the loans every quarter. Okay, so let's delve a little bit more into the income return. The first part is the stuff that's coming in. Obviously, cash interest right at the top. We also track accrued capitalized interest, other income, which is mostly fees, and that equals our gross income, but that's not what's in the total return. So if we keep going, we see that there also could be expenses charged to the loan. Generally, these are servicing fees. There's occasionally some other stuff going on in there. And then there are interest expenses in the case of the senior loans, the whole loans that are part of the GL2, but that are then leveraged to effectively manufacture mezz, or if you will, create synthetic subordinate positions. And it's that net income that's the income component that we show in the total return. So hopefully that's a quick refresher for everybody. Feel free to ask us for the slides. As John said, we're happy to share them. And all this is obviously right there for you to review if you wish to. And with that, I'm going to turn it back over to John.
All right, so this is kind of where we've been, but it's really grossly understated in my mind. So we actually started the data of the GL2 in 2010. It's up, as you can see. the real estate value is over $307 billion. But the real thing is, there's a lot going on beneath the surface. We are pedaling as fast as we can because we have a lot of new data coming in. So this number is grossly understated. But we're backfilling it as the data is added and as quickly as we can vet it. So we're on a pretty good trail to the right and up. No real surprise here. So this is kind of a, where have we been? And again, if you haven't been with us, you'll want to see this. The gray bar all the way on the left in 2010 is stabilized assets. And I think that makes sense because most of what we were doing right after the GFC was stabilized. But as you can see, it's like a ski slope. It has really gone down in size. And so if you look to the right, the right is, in the dark blue, those are bridge or transitional. But the gray, which is stabilized, is really, really, shrunk away to nothing. In fact, if you add both the value add, which is in the yellow, and the bridge in the transitional, that's about 73% of the total. Interestingly, again, when we started, the gray, which is stabilized, was 80% of what we did. It's now less than 20%. Again, I don't think it's any surprise to most of you. Again, somewhat similar. This is, fixed and floating. And again, a reminder that if you're thinking about the GL1, our fixed rate index, all of those are fixed. But the GL2 allows you to either report fixed rate or floating rate or combinations. But if you look in the very beginning, what you'll see is the fixed is, almost 50% when we started. And it's now just over 10%. So again, I think this makes sense to me because if you look at that big orange bars on the right, you'll see it, virtually all floating. Now, this is really important because in the GL1, because it's fixed, when treasuries move, we have large capital movements, both positive and negative. Recently, they've been negative. But because we have almost 85% of the GL2 in floating, you're not seeing near that much capital movement. This is kind of a description of property types. Again, not really a shock to you. So look on the left, 2010, that dark blue bar, that was office. It was over 60% when we started. And if you go all the way to the right, 2023, it's a little over 20%. But what's interesting, of course, is that multifamily is up quite a bit. It's now 35.6%, and multis are in the orange. And then industrial, again, no surprise, is in the yellow, and that's 15%. So, between the two of them, over 50% of the deals are either industrial or multifamily, as compared to over 60% being office when we started. This is one of the charts that gets requested the most, which is how have you done over time? And so we've shown you 10 years of returns here. We could show you 14, but doesn't really matter. And we've tried to compare both the GL2, again, the high yield, the GL1, which is first mortgage, private credit, general accounts, the type that you'd see from a pension fund or an insurer. And then we've compared it to investment grade CMBS and corporate high yields. It's really interesting. The GL2 came about because many of you asked us for an index and you'd be using the GL1. And the general comment was, well, can I just take the GL1 and maybe add 50 basis points or 100 basis points to the total return and call that a high yield index? Our answer was very consistent. You can do that, but we have no idea whether that's right. So you can't use our name because we don't have any data. So that was really the beginning of getting the GL2 was to say, look, we really need to know from loan by loan data what the total returns are. And as you can see, I mean, just take the 5 years, for example. If you just added for the GL1 that 246 and added, say, 100 basis points, that would be wrong because, in fact, the total return for the 10 years, excuse me, for the 5 years was 689. But again, you can use that across the board. You can compare it to high yield corporates if you'd like. You can compare it to CMBS. But the 13510 and since inception are in the far left column. Interestingly, again, on the GL1, because it's fixed rate, we just remind you that the Fed has raised rates 10 times since 2022. And the GL2, of course, being substantially floaters, are not affected that much. So if you're looking for the difference and saying, does the GL1 and the GL2 perform differently? Yes, it does. And the fixed and floating is part of that. So here's the road ahead. We are going to talk about some things that you've never seen before. One, we'll talk about realized IRRs. We've done that a little bit in the past. We're going to go into credit history. That seems to be the hot topic. Risk exposure, again, kind of the same. And then, and this is something we have never done before, we're going to talk about return attribution. So again, what I'd suggest to you is if you'd like to ask a question, you hit the Q&A button, and we'll try to get to you as soon as we can. What I think you're going to see this morning is we have substantial data. And this allows you to think strategically about the road ahead and what risk and rewards you can have. So here to step in and drive is my partner, Michael.
Thanks, John. So we're going to start off by revisiting the realized IRRs. This is something we've done in the past, and the update here that you're looking at on screen now includes 2023's loans. Importantly here, these are the loans for which we have their entire history within GL2. So from the very first funding date right through to the termination, whether that's a payoff or some form of default. If you will, sometimes the term round trip, sometimes cradle to grave is used. This is the history, and these are IRRs, not time-weighted returns, done loan by loan. So I'm not going to walk you through the statistics. The bottom line here is that it's a 9.8% average IRR. And that's actually up a little bit. I think last year was 9.7. So it's ticked up a little tiny bit, probably not meaningful. Let's go to the next slide, though.
Michael, there's a question that came up. In fact, there are two. So let me see if I can ask them both and let you chat about them. Question number one is, which vintage years are included? And then question two, what's the average quote life of a GL2 loan from initial funding determination? You want to talk about both of those?
Let me look. I've got that file up here on the screen. On my other screen. Well, the vintage years is pretty easy. It's 2010 is the first vintage year we would have in this case, and the last one was 2021. So 2010 to 2021, all vintage years are represented in these data, and the average realized life was 30 months.
So that's exactly what you think, because these are usually 3-1-1s. So if you said the average was, 2.5 years, that makes sense to me.
And some were clearly a bit shorter and some were longer, but it averages out to 30. So let's move ahead and look at again something we've talked about in prior webinars, and this is the impact that defaults have on the performance of a portfolio. So in that set of realized IRRs, only 2.5% of the loans defaulted. And remember, there's well over there's almost 400 loans in that sample. So 97.5% of the loans performed as they were underwritten to and expected to perform. Those loans that performed as expected, the non-defaulting loans, generated a 10.8% average IRR. So just that relatively small fraction of loans that defaulted either in whole or in part dragged down the average by 100 basis points. So this is once again kind of the hard facts confirming the importance of keeping defaults to a minimum, if you will, avoiding losers when building and managing portfolios. Uh, Again, a lesson that I think everybody's well aware of, but that there's nothing like seeing it and understanding how badly you can be hurt by having a few losers in a portfolio. So let's move on and go to the credit loss side, because speaking of losers, let's talk about credit losses. Uh, those who were with us in prior years know that we've done this, I think it was the first time was last year, where we really did the full exposition of credit loss history in the GL2. So let's talk about what we include when we're talking about credit losses so that we're all understanding what our methodology is. So the first thing we include is cases where some of the interest was forgiven on the loan. So the interest that was originally contracted for, not all of it was obtained. Even though that's probably an understanding and agreed upon ultimately, it is, in our view at least, a form of credit loss. The most significant one is what we just talked about. That would be defaults, either in whole or in part. But a couple other categories that come in. One is the sale of non-performing loans. So just as we, GL, do not determine the valuations, we also are not the auditors of the status of a loan. These are the statuses reported by the participants to us. Now, to be sure, if we see a loan that had been paying interest and it's now no longer reported as paying cash interest, let's say, we'll make a call and say, is what's going on here, so that if somebody inadvertently forgot to change a status flag, we do pick that up. But these are strictly then non-performing loan sales. And also if a loan is restructured so that it remained in the data and it's performing, but it was restructured and there was a loss greater than 2%, we consider that for inclusion in the credit loss study. We include stuff, we also exclude a lot of things. So there's a whole bunch of those. The delinquent loans that are cured completely, they're not included as a credit loss. Cases where there is interest forbearance, so a deferral, let's say, for a period of time, no subsequent credit events, good. Interest deferral is fully paid, all good. Restructured deals with very minimal losses. And then we don't include in the credit loss study history any loans that are currently in default, but that are still carried on the lender's books. And we'll look at some of those as we go along.
Michael, the gang is chatty this morning, so let me ask another question while we're here. Quote, does unpaid interest on delinquent loans get counted as a credit loss?
That's a little bit, I won't say tricky to answer. It's not in the credit loss history you're going to see, because the loans that are currently in default, if interest is not being paid, because we're computing returns as IRRs, which use cash flows, the lack of that interest being received is dampening the return. So that, to that extent, it's reflected in there. Later, if the loan conditions on that loan get worse, presumably we'll start seeing marks on the loan's value that'll be picked up in the current, but it's not going to show up in the credit loss history data that we show until there's a resolution on the loan. That was a good question.
Thanks. Press ahead.
So here's the numbers, folks. I'm not going to walk you through line by line. I will point out we look at the default rate two ways. One is by count of loans, the other is by dollar amount. We also show you the loss severity and then the annual credit loss. And just as a reminder, if you take the dollar default rate and multiply it by the severity, effectively you get the credit loss for the year. I think some things that are interesting on this are that we see there are some credit losses historically, and then there's a big uptick in 2020. the year of COVID or the year COVID starts, where we see both an uptick in the rate of incidence, but also a very large severity. I'll tell you, because before somebody asks, several of these were lodging loans that went completely bad. Again, I don't think that's a surprise to anybody. 2021, we still have a fair rate of incidents, but very low severity, so very low credit losses in 21. Again, that seems kind of
Michael,
consistent
the,
with
the,
economic.
the hospitality was 2020. Is that what you just said?
I think largely was hospitality.
Okay, makes perfect sense.
Yeah. And then look at what's happening in 2022 and 23. We're starting to see an uptick in credit. I don't think folks should be shocked by that, given the pressure that's occurring in the economy and that's certainly affecting commercial real estate. I think the thing that struck me on this exhibit, I don't know if it'll strike you the same way, is the ramp up in severity that we're seeing. So this is a theme that we want to return to as we look forward and now talk about if these are the realized losses, and we've talked about there are delinquencies and defaults, let's take a look at those and kind of what's happening now with the loans that are in the index. Because remember, everything that's in this credit loss history is out of the index. These are all fully crystallized events. So this is an exhibit that we provide every quarter to participants that shows the incidence of credit events by various categories within the active index. This is the fourth quarter result. Again, taking a quick look at it, let's look at the row labeled delinquent and defaulted, and we'll call that the distressed loans. Rising, both, no matter which measure of incidence we use. Again, I don't think that's a surprise, but these things are ticking up rapidly. So let's explore why that's happened and then come back toward the tail end. I think when John and I conclude, we'll make some comments on kind of how we perceive the environment going forward. But let's look at what's underpinning this rise in delinquent and defaulted loans, a level of distress. Well, if we take all the loans, all the sub-debt deals that were active in GL2 as of year end 2023, and look back to when they were underwritten, only really less than 20% of the loans had an upper LTV or a detached LTV greater than 75%. There's some, high up in the cap stack deals in the index, to be sure. That's what the scatter chart is. One of my old colleagues used to call it the bug diagram because it looked like bugs on a windshield chart shows. Okay, so keep that number in mind, 20%, less than 20% with above 75% exposure in the cap stack. Let's go to where we are today. And we're going to take a step along the way with the next slide. So what happens to change the cap stack position? Well, some principal could be repaid, lowering the exposure, but some cases loans get upsized. So the amount of principal is increasing. But the big factor really, at least at this stage in the cycle, has been how have the underlying collateral value, the property values changed over time. So what we did, kind of a quick and dirty approach, we took the underwritten cap stack positions. Those are the two columns over to the left that are all in black. And then using price change index data from the NCREIF property index, we updated the collateral value for every loan that was active in GL2 at the end of 2023. And then tallied them up by sector, property sector here. Again, I don't think anybody's going to be surprised to see that there are some in the red losers and some in the green winners. Office being a prime example of a sector that's losing ground, and industrial, a sector that's gaining ground. Bottom line, when we average across all those active loans, we put it here in red, but you'd look at it and say, gee, Michael, that doesn't really look like it's increased that much. So is the risk really that much greater? And that's where we need to look at the next exhibit and delve into what we call tail risk. So let's go to the next chart. Yes,
Before you go there, lodging, we talked earlier about lodging in 2020 being, in the tank, and it was, but here, it's green, it's going down. Any thoughts?
Improvements in values and operating conditions
Okay.
in recent years. Any folks out there who are doing lodging know that there has been a recovery in that sector. In fact, I believe if we look at some of the indices, such as the NCREIF index, so we're looking at real estate equity, I think that might have been the only sector that showed some increase in value last year.
Thank you.
So let's talk about what we call tail risk. Well, you think about it, right? There's winners and losers in the sectors. So the winners, the ones in green, where that means their cap stack positioning improved. So their orange dot on this chart is where they are today. The blue dot is where they were when they got underwritten. So the orange dots, some of them are down low and to the left. Credit quality improved in the migration. Others, though, the ones in red, the ones in red from the prior chart, are shown here as they are today as the orange color, and they've migrated up. Their cap stack positioning is worsened relative to what was underwritten. And the kind of shocking number is was under 20% of the loans were underwritten with less than 75% upper LTV or detached LTV. Now almost 40% has fallen into that category. And that's where the pressure is building that's underpinning that delinquency and default. The level of distress increase is coming partially from this financial positioning, which again is driven largely by collateral value changes. One interesting thing here, you can see it is, you'll see that big ellipse or oval on it. You say, oh, gee, those orange dots now have an attached LTV of 0. Those were senior loans that were leveraged, and they were intended to be leveraged when they were underwritten. They were leveraged, but recently, as a risk mitigant, the leverage has been removed from those. So the borrowing, the advance rates have been paid down. And they've still been subject to the collateral value changes in the credit quality migration, but some of them have been de-risked by the portfolio managers. Okay. Changing topics here. Now we're not done with credit. We'll come back to it. But let's talk about some of the new analytics. First thing's a market structure report. We actually started producing this for fourth quarter, and I believe all our participants have received it. We'll take a quick look at that on the next slide. So this exhibit over to the right on the slide is sort of the upper left corner of the full report. Let's take what's highlighted in blue, which is office mezzanine loans. And this will show you the approach of what we mean by the market structure. So what we're really doing here is looking at the index, not categorized or classified along one aspect, such as property type or by loan type, but instead looking at two ways to categorize the index. In this case, property type and the type of loan, mezz debt, leveraged whole loan. Things you don't see are stuff like B notes, and other things will be over to the right on the report. So this gives a deeper dive into what the index looks like and how these, if you will, quote, cells are performing. So our office mezz in the fourth quarter of 2023 was about 13.3% of the index, and not surprisingly, it had a negative rate of return for the quarter. Again, this is a great way, we think, to look at it, and this was largely in response by us to requests from participants saying, hey, could we look at this in a more granular sense? Now, we're never going to share loan by loan information with folks, but this gives a more granular or more magnified view of what's going on in the index. Keep this structure in mind, because as we talk about return attribution, we're going to use very much this type of two-dimensional structure as one of the ways we can look at excess return. So let's move on to that topic of return attribution. This is in beta test mode. We've shared some reports with a few participants. We're happy to share with everybody, and we're going to start, I think the plan will be when we have the first quarter 2024, which should be imminent. We will do this set of reports you're about to see for all the participants. And again, It's in beta test. It's not cast in stone at this point. We're very amenable to changes, doing further explanations and adjusting it if need be to suit what folks need. So let's talk about the performance attribution. And basically what we're trying to do here is come up with something that I think is really underpinned what John and I have been trying to do with the indexes for 30 plus years now. And that's answer the question, how do you know? And provide a quantitative answer to how do you know how private market mortgages have performed as an asset category? How do you know whether they might be additive to a portfolio um, in terms of risk and return? And importantly here, how do you know how well a portfolio is performing or how well the index is performing and why? So the first thing is what we term absolute return attribution, explaining the number, and that number is the total return for a period of time. It can be a quarter, it can be a year, it can be 5 years, it can be 10 years. The number, the total return that an index or a portfolio generated. And the attribution is to, again, do a bit of a deeper dive and understand where the number came from. And the idea here, or the construct, is that the portfolio's return or the index's return is the sum of what each of the components contributes to it. So let's go into an example. I think everything here is clarified a bit by looking at an example. So a lot of words and a lot of numbers on this chart. The words over to the left are for reference. So if you need to go through and refresh what all these terms are and the abbreviations that are used, they're all there. But let's focus on the office sector. I'll walk you through what we're doing here. And in particular, let's just concentrate on the 1 year results. Now, this is for the index. So this is the office sector within the overall GL2 for the year 2023. TR, total return for the office sector, was about negative 1.2%. The average weight of the index in offices was about 28%. So the contribution to the total return for the index is multiply the total return by the weight, and you get the contribution. A little bit of more technical math than that in it, but effectively that's what's going on here. Multiply total return by weight and you get the contribution. In this case, negative 34 points from the office sector. So again, no surprise, the office sector pulled down the entire index return, which if we click, we'll see at the bottom of the page that the sum of the contributions is equal to the total return for the index, as we said in the construct. Okay, keep this in mind and let's forge ahead. And that's moving to excess return attribution, which I think is really the more critical and in many ways the more informative one. And the excess return explaining the difference between the return a portfolio generates and the return that's posted by its index or benchmark is really important. And this builds on the absolute return analysis that we just looked at. What we do is we look at the absolute return and the contributions to return of a portfolio and the contributions for all those sectors, its counterparts within the index. And then the net of those two is going to give us the contribution to the excess return. We also can tease out a couple of extra things that are pretty interesting, the allocation effect and the selection effect. Rather than me reading you what's here, let's delve into it and put some numbers to this. So this chart rather this page, the numbers over to the right are exactly the ones we just looked at. This is the absolute return by property sector and their contributions to the index's return, except in this case, we put a nice little bubble chart over to the left rather than all the verbiage that we had in the other one. So again, let's highlight the office sector here. Same numbers as before. Focus on the contribution and kind of, if you will, keep in the back of your mind, I'll remind you what the total return and average weights are. So the contribution, negative 34 basis points from the office sector to the index's total return. Now let's look at a portfolio in the same way. So absolute return to a portfolio. And again, we'll highlight office. We see the numbers there. For office, a 10.82% total return for the calendar year. Much better than how office has performed in the index, but a weighting of only 5% compared to the 28% in the index. Net result, a positive rather than a negative contribution of 56 basis points to this portfolio's return. Now, it's important for me to remind you or to mention, because I didn't, this is none of your actual portfolios. This is loan level, real loan level data, but we just took a sample of loans out of the index and used it to make the portfolio.
I was waiting
Don't
for
worry.
emails to come in that were going to light up and say, is that mine? Thank you.
No, we do have yours. If you're a current participant in the index, we can generate yours. And as I said, we aim to put that in quasi beta test production after the first quarter results are in. Again, you can see that this portfolio actually did relatively well. So let's go to the excess return. And again, we're going to highlight the office sector. It's not that we're picking on it. It just happens to be at the top of the list and it's easy to see. So remember, we had the index office sector return contributed minus 34 basis points. The portfolio's office sector returned plus 56 basis points. Plus 56 minus 34, 90 basis points. The column labeled CXS on this exhibit is the contribution to the excess return. So the net from the office sector was about 90 basis points of positive excess return created in this portfolio by what happened in the office sector. But further, we can gain additional insight by looking at that contribution, and it has a couple of components. One is what's called, and this is all very standard in the attribution world, by the way. I should have said that at the outset. We didn't invent any of this. We're just applying existing well understood methodology to the GL2. So remember that in the portfolio, office was about 28%. I'm sorry, it was in the index was 28%. In the portfolio was only 5%. And in the index, office was an underperformer. It had a negative contribution. So the fact that the portfolio underweighted office is a win for the portfolio because it underweighted a sector that underperformed in the index. That's the AXS that we see in this chart. So what's the SXS? That's the selection contribution. Also recall that the office assets in the index return had a negative. It was like negative 1.2%. This portfolio, a whopping 10.8% for its office loans. So it says another win for this portfolio. They win with being underweight office, and then within office, in addition, they knocked the lights out on the performance. So the office assets they chose were very good. They got a double win for excess return from what happened in the for what they did in the office sector, which was the combination of underweighting it but picking really good assets.
Michael, there's a question that just came in. So let's stop a minute and see if we can get that question. Yeah. As you see on the slide, it says benchmark all GL2 loans. The question is, are all GL2 loans the only benchmark that can be used? Question.
The shorter answer is no. I think initially is probably what we'll use just so everybody gets the same reports. But that's a good question because no, we can customize the index to suit. It could be a subset of GL2. It could even be something else, although GL2 is what we'd like to work with. For instance, if, let me hypothesize, maybe somebody would only want to see loans held by open-end commingled debt funds. We could do that. Would be an alternative.
Yeah, just in case you're new to the index, we do quite a bit of custom benchmarking on the GL1 and the GL2. So if you need something that is customized, let us know and we'll tell you whether we can get it done or not. Michael?
Yeah, let's go back and let's skip ahead. And again, I like pictures personally. This is a graphic illustration of all those numbers that were on the prior page. The blue, solid blue bars or columns, if you will, are the allocation contribution of each of the property sectors. And then over the last columns to the right are the sum of all the contributions. So the portfolio excess return total. The orange is the selection effect contribution, and the red diamonds or squares turned on their side are the total return. So what we see here is a mix of positives and negatives, both for the asset selection, or rather the asset selection, and also for the, asset, the allocation decision and the selection decision. For this portfolio, while there's pluses and minuses, most of the excess return was driven by a positive allocation result. So really the construction of the portfolio in terms of over and underweighting was the largest driver of return. The selection effect, while positive in some sectors, was actually net negative on average, very slightly net negative. So it did kind of undercut return a little bit. And then the industrial, which was by far and away the biggest contributor of positive results to the excess return, was an interesting story. Unlike the office, where it was labeled win-win, portfolio won because it underweighted offices and won because it chose good assets within the office sector. Here, it's a little bit different story. Big win by choosing to overweight industrial, but detraction, a loss, if you will, from not choosing the best assets within that. So again, this is the why of the excess return and what one can learn by doing this. And the next slide we go into is really the deep dive. And this is the portfolio manager's report card. This is taking that view that we used for the market structure report, that two-dimensional or two-category view, and expanding it out to include looking at the portfolio and the benchmark and the excess return. So very quickly, you can see some green arrows pointing up and some red arrows pointing down. The green arrows are cases that show positive results for the portfolio relative to the benchmark. The red are negative. You can pick out the office mezzanine loans were a positive, both in terms of generating excess return and in terms of their contribution. You can also see that leveraged senior loans was a negative contribution. That's because this portfolio didn't have any in it. So it had zero excess return. It'd be unfair to say they had a negative excess return if they didn't invest in the sector. But because they chose not to be in that sector as part of their portfolio construction, there was a slight negative effect in there. And then over to the left, we showed the total allocation and selection effects and the total excess return. So this is kind of where we're going. And we expect to be generating, as I say, beta test versions of these after first quarter. Basic results are out. We'll get it with all the participants and share these portfolio management reports. And then, John, why don't you talk about some next steps?
Yeah, so in case this is not abundantly clear, we've been busy. I kind of reminded of those TV commercials that used to appear late at night, but wait, there's more. And there is more. We're now moving to attribution to the fund level. So I think Michael and I have always thought that really the performance of the real estate investments, that's the main determinant. And we think a logical add-on was attribution, but there are certain things that aren't in that. For example, there's no cash holdings. There's no fund level debt because again, we're in the loan level business. So now we're starting to create fund level indices. And I think it's fair to say that an open-ended commingled debt fund index for the fund level is coming fairly soon. So if you'd like to be part of that, we invite your participation. As with everything we've done, we've learned a lot from the founders and the sponsors. So please let us know. You can email us, you can call us, you can write us any way you want. But if you'd like to be part of the fund level index, we're open to your thoughts. Michael?
Yeah, thanks, John. John, I did see that we got another question online while you were covering that slide. Uh,
Okay.
and the question is about somebody picked up that when we were looking back, way back at the realized IRRs, let's
Oh, yeah,
not
I see it.
go back to that, that uh, the unleveraged senior loans actually had a higher IRR. And kind of the question was, and this is a very reasonable question, how could that be? They weren't leveraged, so how'd they do better? And the answer is that there's a lot of dimensions of risk and return that we can't show on that single chart. So it's entirely possible that all the senior loans that are realized were dominated by loans on value added assets. And they were really the so-called stretch seniors, where the loans may have gone up 80, 85% of the capital structure. So that's likely what was going on. If you're curious, while we don't have the data, or while it doesn't include the 2023 results, I did write a research paper a couple of years ago that actually shows the components of what's in the IRRs and how both the nature of the underlying real estate, the cap stack positioning, et cetera, drove the realized IRRs. So if you need a copy of that, let us know.
Okay, thank you.
All right, so back to the topic of where might we be going? And I think really there the focus is uh, for most of us on what's the credit loss perspective. Well, if you look relative to uh, private market real estate equity, this high yield CRE debt has held up reasonably well. As John showed the comparisons before with fixed income, the CMBS and the GL1. So this is against the NCREIF index, which is unleveraged real estate, commercial real estate assets institutionally held, and the Odyssey Fund Index, which is same, not identical, but the same assets. The Odyssey, most of their assets are in NCREIF, but the fund index, so that would include the effects of leverage in it. So can you say volatility? It was a
There it is.
tremendous ride over the last few years, really a roller coaster if you were in the equity real estate realm. And though, to be sure, the 2023 results for the GL2 were well below average. It was under 6%. And you can see the longer run average is well above 8. So it's not that the GL2 was immune, but it's held up reasonably well in this current down cycle. Again, I'm not going to talk through the statistics. They're pretty clear over on the other side. But let's look again at distress. These are a comparison that I don't think we've shown before, John.
No, we have not.
And that's to look at we've got, again, this is not the credit loss history. This is the level of distressed loans. So if you think back, this is that, as I mentioned, the report in our reports every quarter, and we went back historically and looked at them. The orange line at the bottom is the American Council of Life Insurance loans, and I'm calling these distressed, so it's delinquent, defaulted, restructured. The ACLI, again, all seen, well, no, I shouldn't say. The ACLI does include, potentially has some mezz debt in there and floating rate debt as well as fixed, because this is not the GL1. But still, mostly senior loans, mostly fixed rate loans. And it's ticked up, to be sure. It's not immune from what's going on in the environment. CMBS has already started to tick up in 2023 from its more steady level. And we're seeing the same thing in the GL2, largely response to the stresses we're seeing with declining collateral values and the tail risk increasing, which we've talked about before. One of my thoughts is that, John and I have read a lot of history, and we learned from our history books, because we weren't around,
Of course
that
not.
in the mid 80s and the early 90s, things were really bad in real estate. There was a lot of stress in the environment, a lot of defaults in lenders' portfolios. The thrift industry was devastated by bad real estate, and there were some lessons learned. And in addition, in the very early 90s, the public markets in the form of both equity real estate investment trusts and CMBS kind of stepped in to help do recapitalization. And then we hit the great financial crisis, and CMBS was stress tested in the GFC. And, they got through it. But some of the flaws, some of the challenges in the structure were exposed, and we then had CMBS 2.0 come on. So kind of cycle tested for CMBS. And my personal view is this is going to be the cycle test, or the cycle that's going to test high yield commercial real estate debt. It's not that it didn't exist before. I invested in it in one of the portfolios I used to manage. John, I know you're familiar with it.
Yes.
So it's not that it's new. It went through the GFC, and we all probably have both positive and negative stories about our experience with, say, mezz debt in the GFC, but it just wasn't as prominent a part of investor portfolios as it is now. So I think this is the test that will really give us information. And unfortunately, we don't have in GL1 the GFC data. We start in 2010.
Yeah, that's an interesting question. If you, we've started the GL2 in 2010. We do have some data that goes back pre-GFC, but if you have additional data, we're willing to go back and add that, and who knows, maybe we can come up with a GL2 that starts before the GFC. Right now, we have the data. There's just not enough to put it into an index. Okay, we have covered a lot of ground today. We've covered fund levels, we've covered attribution analysis, we've covered allocations, we've covered credit, and you guys have been very, very chatty in the questions. So if we got to your questions, I'm delighted. If we didn't, we will try to respond to you directly. Meanwhile, if you have questions about the GL1 or the GL2 for that matter, call, email us, and we'd love to see how we can get you some of the data. Just a last minute housekeeping note. The conference has been recorded as always, and it's available. Again, Julia Grant's the gatekeeper for all that. In addition, when you sign off, there's a Zoom survey. And we'd really like it if you'd fill that in. That helps us do a better job for you next year. We are welcome and open to different and increased participations and data contributions. So if you're there and you have data and we don't have it, please give us a call. Meanwhile, I think we are, as I promised most of you, we would be just at about an hour, and we are. So thank you very much for joining the GL2. We look forward to hearing from you. If you have any questions, Julia Grant's in charge, and she can help you. Thank you.
Thank you.